Sure.
What do you make of them? What's the headline for you?
So it's great for the fundamentals because it seems that there's still a very large amount of demand for labor, but it's not causing a gigantic increase in wages. So for the Fed, that's the easiest thing to manage, where you've got sort of strong underlying growth, but not strong growth of inflation.
But does it give the Fed any pause that their models might be off? Because normally you would expect more wage pressure right now, given where we are in the cycle.
There's a lot of uncertainty about the relationship between sort of the underlying growth and the labor process and inflation. We've been seeing that kind of breakdown over a longer period of time. The unemployment rate has gone from 10% down to 4%. We've seen relatively modest wage growth. The challenge has been low productivity growth. And that's where we really need to see higher growth, because then you can have higher growth in wages and more economic growth without inflation.
Damian, why is the curve steepening right now?
That's a good question. I mean, look, this is great for equity markets. I think you hit the nail on the head in saying it's a Goldilocks scenario, but I think a weaker number would have been great for credit. I think that's where, fixed income markets are struggling now and sort of trying to find their way here with, with spreads at all-time tights.
Because I have to wonder if this is more, because we're seeing more selling, obviously, in the long end. You have 30-year yields now down by 4 basis points, and the question, up by 4 basis points, and I feel like the question is, does this push out rate hikes? If we thought we were going to have more now, less later, is this now a more later, less now scenario?
That's a good point. Are we still stealing from 2019? I mean, look, short positioning in the 10-year is much more acute than the 2-year right now. So I think that curve flattening trend will remain intact. I think it will continue. But yes, I think fixed income markets are trying to find their footing here.
So, Mike, let's come back to the productivity issue for a second, because that may be part of the key to what you identified is, can you have growth without the inflation? That's what people in the White House say they're going to get. But can you get increased productivity without higher wages? Because normally that's what drives a company to get more productive.
Well, what you'd like to see is productivity rise before wages do, because then you're paying for it with additional output. The question for a lot of people about the tax cuts is what in them would drive additional productivity gains other than just throwing money at companies who could have invested. They've got a lot of cash on the balance sheet for the last number of years. So it isn't clear yet exactly what's going to drive productivity in the future. And if you did have a gain from additional capital deepening, that's going to take time to show up in the economy. So productivity probably, unless there's some miraculous change, is some way down the road, even if the tax cuts work. The question is, do you get the wage increases before that then become an inflationary problem for the Fed?